basically two different sets of numbers that the government uses to measure inflation. The original set of numbers that they used from World War II until 1982, and then from 1982 until today, they keep on adjusting the CPI, and so I call it the CP lie because it way underestimates inflation. But even using that calculator, you come up with more than $200 an ounce to equal the value that silver had back in January of 1980. I mean, name something else that's selling at a discount to its 1980 price, and you really can't. When you compare it, in my book, The Great Gold and Silver Rush of the 21st Century, I compare it to the percentage price change in stocks, real estate, bonds, the growth of the M2 currency supply, and the Wilshire 5000 index, which incorporates pretty much all of the publicly listed stocks in the United States. I'm looking for some pretty spectacular prices. And then you've got things like mainstream banks, Morgan Stanley, recommending to go from a 60-40 portfolio, 60% stocks, 40% bonds, to 60% stocks, 20% bonds, and 20% gold. So they're saying sell half of your bond holdings and convert them to gold. This is just like a whole new world. This, to me, signals the beginning of the third and final phase of a bull market, and that is where you have the greatest amount of gains in the shortest period of time. So we should be seeing some fireworks coming.
In market cycles of the past, the sharpest gains often appear in a final third phase of a bull market. This is when momentum, leverage, and speculative enthusiasm conspire to generate explosive returns. In the current context, the shift toward gold signals that we may be at that moment, the prelude to fireworks. Historically, such phases occur when mainstream participation crosses an inflection point. Central bank signals align, and the broader investing public realizes the magnitude of the opportunity. The suggestion here: we are standing on the threshold of the most dramatic run in precious metal history.
For the first half of that bull market, it was just Western Europe. Canada was a very small population, but they did participate. The U.S. didn't join the party until the first day of 1975. And it's interesting, Roosevelt had made gold ownership illegal back in 1933, and but I believe it was 73% of the gold coins in circulation were not turned in. They remained illegally in private hands. And so when gold became legal to own in the United States, first day of 1975, it had gone from $35 to just under $200 an ounce by the end of 74. First day of 1975, it started to fall. And I believe that's all these people that were sitting on the coins that were passed down from their father, their grandfather, whatever, and they had been sitting on them for 50 years, not able to sell them because they were illegal. And so all these Ellis came out of from hiding, and at the same time, there was a bear market in stocks that ended, and stocks started recovering. And so gold went from just under $200 an ounce down to $103. It lost almost 50% over the next, I believe it was 18 months or so. It was toward the end of 76 that it bottomed at 103, but then it turned around. And the intraday high was actually $873, not the $850. $850 is the close. The intraday, though, $873. Coincidentally, the Dow Jones Industrial Average was at 873 points at the same moment. So it was a 1-to-1 ratio, Dow Gold.
Consider the late 1970s. In the United States, after owners regained the legal right to hold gold in 1975, the metal had already risen dramatically from the $35 aughts era of the early 30s. Hidden hordes of private coins emerged, bear markets in equities ended, inflation surged, and gold climbed toward $850. These patterns illustrate how deregulation, latent inventories, and macro shocks can coalesce. In today's world, while the context differs, the structural ingredients, precious metal disenfranchisement, system stress, and mass investor realization, echo that earlier period. It's a compelling historical blueprint.
This is a very difficult thing because I do believe that there is a giant crisis heading towards us. If you look at like the 1929, that was a stock market bubble only. Real estate was not in a bubble. Gold was fixed. It was $20.67 an ounce. And then you go to 1966, stocks were in a bubble, and they corrected from 66 to 1982. The Dow Jones bumped its head on 1,000 points and couldn't break through from 66 to 82. And during that time, we had raging inflation. Company profits went up, the number of dollars that they were in. So all the price earnings ratio, the PE, all the ways that you can measure whether a stock market is in a bubble or not, it corrected. And stocks became severely undervalued by 1982. Then we went into the tech bubble in 1999-2000, and stocks were extremely overvalued and then crashed, and we ended up with, each one of these crashes and corrections. I don't know, there's not that many people that recall the 1970s, but the raging inflation we had and then the double dip recession that we had at the beginning of the Reagan era, there were some pretty tough times. Even though we didn't have a major stock market crash, we had this slow grinding correction. With the NASDAQ bubble, we had a major stock market crash that ended up in a recession, but real estate was not overvalued. Then we get to the global financial crisis. Stocks were not overvalued. They were back down in the fair value region because of the NASDAQ crash, and it was real estate that was in a bubble. Today, we have historic bubbles in real estate, stocks, and bonds. And I mean, the only way that you can measure stocks that doesn't show them in the largest bubble in history, it shows them in the second largest, is PE ratios. But every other indicator shows stocks being more overvalued than at any point in history. And then when you look at commercial real estate and residential, same thing. It's the more overvalued than we were in 2007. And so it's going to be a crash of all of these asset classes against gold and silver. One thing about bubbles is they can't go forever. When the economy starts out balanced and you've got one sector of the economy growing so much faster than the whole rest of the economy, and your audience can feel that a couple of years ago, the stock market, the markets in general sort of detached from the real economy. The real economy is not doing that well. But stock markets, real estate, stuff seems like it's gone insane. And then the national debt, and it isn't just the U.S., it's all over the planet where countries are spending their way into oblivion.
Today's system is facing an unusual convergence of bubbles. Stocks, real estate, and bonds are all arguably extended. We've seen past episodes where one asset class dominated, for example, the tech bubble around 2000 or real estate in 2007. Now, all three major asset pillars are at elevated valuations simultaneously. That creates a scenario where a broad correction could trigger a systemic shift. Precious metals, particularly gold and silver, become not just hedges but potential beneficiaries of capital flight from overcrowded sectors. The risk-return calculus is tilting.
I think the tariffs that have been imposed are perturbing the world economy enough. It's just taking a little while for it to happen. Right now, everybody is betting on the AI bubble. That is going to be so huge that there's nothing to worry about. I just think there's going to be this giant correction, but tariffs and world trade. When you install tariffs, you slow down world trade, and I think that will be the thing that ends up popping this. We'll have some other event that sort of that coincides with all of this, and You never know what is going to come. When the NASDAQ crashed, Alan Greenspan tried to reflate the stock markets. He didn't see the real estate bubble he was creating over here out of the periphery of his vision. But that whole global financial crisis, that was caused by Alan Greenspan's reaction to that, and then all of these new things like mortgage-backed securities and collateralized debt obligations and so on. But he didn't see that coming at all. He created that bubble, and he didn't see it. And so you never know what's going to come at you out of left field.
Within the precious metals complex, one ratio stands out: the gold-silver ratio. How many ounces of silver equal 1 ounce of gold? Historically, this ratio ranged 13 to 16 to 1 in classical times. In modern eras, it has stretched far higher. Currently, silver is facing a structural shortage, with mining supply lagging demand by several years. As industrial uses, from electronics to solar to AI, accelerate, silver may be positioned for outsized gains relative to gold. Investors who recognize the timing of that move may capture a unique entry point.
I intend on selling tranches. The first thing is I try to not make my investment decisions based on emotions. And so I use the gold-silver ratio to tell me whether or not to buy gold or silver. And because the gold-silver ratio has been so out of whack, I own 300 ounces of silver for every ounce of gold. It will come back into balance one day. We don't know when. It's going to take a little while. But I believe you're going to see the gold-silver ratio in the 20s or less. In other words, right now it takes 85 ounces of silver to equal the value of 1 ounce of gold. If it takes 80 and you buy silver and it goes down to 20 and you sell your silver and buy gold with it, you just got 4 times more gold than you paid for. And so it's a strategy that can be back tested. It works. For 2,500 years, the average exchange rate was about 13 to 16, somewhere in that range, ounces of silver to 1 ounce of gold. So this is something that has only existed since the big discoveries of the Comstock Lode and the Silver Valley in Coeur d'Alene, Idaho, back in the late 1800s, and simultaneously governments around the world went on the classical gold standard and treasuries dishoarded their stockpiles of silver. And so all this silver flooded onto the market and silver's value plummeted compared to gold's value. And it has bounced up and down, but we've been at these historic high areas of like 100 to 1. And during COVID, 120 to 1, which had never happened. In 2,500 years of gold and silver being money, that had never happened. And so this was something that was a great opportunity. And by allowing the gold-silver ratio to sort of dictate to me which one I'm going to buy, I ended up buying a bunch of silver during COVID, right around $11 an ounce. And so that was pretty nice.
Pretty nice.
Right. But like I say, it's nowhere near done. When you look at how the bull market of the 70s progressed, and then you look at this natural balance that different sectors of the economy, stocks, bonds, real estate, precious metals, energy, and when you do these, they're called ratio charts, where you divide one thing by the other. What you're doing is you're eliminating the national fiat currency from the equation. And the national fiat currency creates this smokescreen, this fog that we can't see through. You can't see what true value is. So, you can get an idea of this. There's a couple of online chapters from my last book at ggsr21.com. And chapter 3 is the shortest and most entertaining chapter, and it's going to benefit you for the rest of it. It's just a primer on how to read charts and how to see when whoever created that chart is trying to lie to you, how they're trying to influence your perception. And but it shows you that the way things are priced in national fiat currencies, it's very difficult to perceive what true value is.
No investment strategy works purely on optimism. Discipline and risk control matter. Leveraging the gold-silver ratio, some investors allocate more silver when the ratio is elevated and shift toward gold when it compresses. By doing so, they align strategy with history and structure, not emotion. Yet the timing remains uncertain. External shocks, tariffs, monetary policy missteps, or a surprise crisis could trigger the move. Moreover, just because the stage is set doesn't mean the curtain rises tomorrow. Patience, readiness, and the right mindset will determine whether this becomes the defining bull run of our era.
It had only basically reached the level that it was at in 1980. Inflation, just using what I call this, I'm the person that coined the term the CP lie. There's basically two different sets of numbers that the government uses to measure inflation. The original set of numbers that they used from World War II until 1982, and then from 1982 until today, they keep on adjusting the CPI, and so I call it the CP lie because it way underestimates inflation. But even using that calculator, you come up with more than $200 an ounce to equal the value that silver had back in January of 1980. I mean, name something else that's selling at a discount to its 1980 price, and you really can't. When you compare it, in my book, The Great Gold and Silver Rush of the 21st Century, I compare it to the percentage price change in stocks, real estate, bonds, the growth of the M2 currency supply, and the Wilshire 5000 index, which incorporates pretty much all of the publicly listed stocks in the United States. And you end up with these price projections that range from $200 to about $2,000. I mean, some of them just are absurd, except it's just math. And the thing is that we have a tremendous shortage and a lack of supply of silver right now. We didn't have that back in 1980. This is a different. I don't understand the structural deficits that we have in silver, where there's less supply coming to market than the demand for silver each year, and the prices still being down where they were back in 1980.